Good morning, everyone, and welcome to the first half 2018 results presentation for Interserve. Mark Whiteling and I will be presenting this morning. To kick off this morning, and as I said back in May, which doesn't actually seem that long ago now, the health and safety of our employees is the group's number one priority. And I'm pleased to report that the group's lost time injury frequency rate has dropped from 1.3 at the end of 2017 and is 1.1 at the end of June 2018. This is a really encouraging trend for our group as we aim to keep all of our employees safe and well. Moving on to the agenda, we'll spend a few minutes reviewing the first half highlights, and then Mark will take you through the financial performance for the first half and an update on the financial and operational performance of energy from waste. The final section of today will include a reminder of the group's strategic priorities, a business update on Fit for Growth and how our plans are progressing there, and of course on our three main activities, followed by a progress update on our support services strategy. So the highlights this morning, total operating profit, managed to move the, there we go. Total operating profit of 40 million is in line with management's expectations and is an increase of 40% versus the second half of 2017. This is underpinned by the implementation of our Fit for Growth plans, which delivered 8 million in the first half and are on track to deliver 15 million for the full year. This robust financial performance was during a period of significant contract mobilisations for the group. We also conducted the review of our strategy for support services. We increased financial and management control over our business development activities across the group, and of course had laser-like focus on the completion and commissioning of the energy from waste contracts. Our future workload is stable and our pipeline is strong and now reflects the priorities of the businesses. The group, however, does continue to have challenging market conditions in the Middle East, particularly relating to Qatar. However, we're seeing an uptick in activity relating to the oil and gas businesses in the region. In summary, the first half is characterised by robust financial performance, good operational progress and strong momentum on Fit for Growth. I'll now hand over to Mark to take you through the detailed financials.
Thanks, Debbie. Good morning, everyone. Whoops. Thanks. I was going to try and make a follow-up quip to the one-liner that I did at the full year, but I couldn't think of anything funny to say, so I was going to just wipe that out completely, actually, but no. Anyway. I'm going to just start with a few comments on the P&L overall and just to sort of give you an overall shape. There's obviously some more detailed slides behind it on a couple of the key line items, but as Debbie said, and then Debbie's going to talk about the individual business performance. As you can see, overall group revenue was down nearly 10% at 1.5 billion, with the biggest drop in UK construction down just over 106 million pounds. This is partly a consequence of the reduced revenue from energy from waste, as well as a deliberate focus on the smaller and more profitable opportunities that we have. Equipment services revenue was down, and as we saw lower activities in a couple of markets and the impact, as Debbie said, of the embargo in Qatar. Headline operating profit, that is before non-underlying items and the amortisation of acquired intangibles, was £40.1 million compared to £56.6 million last year. And this is despite the benefit of the cost actions which we commenced last year and reflects the benefit of some of the one-off gains that we had in the first half in support services last year, the impact on equipment services which was down in the first half, and then the increased cost base that we've seen in support services following the move into Ingenuity House, which is as we consolidated and upgraded our offices in Birmingham. As you can see, interest up substantially, and I have a separate slide on interest just to take you through the build on the interest because there's a number of factors which are influencing that. And then the tax charge for the period reflects the mix of the group and the inability to obtain tax relief on certain of the non-underlying costs, and that's really why that distorts that. Turning then to the non-underlying items, and I hope at some point in time the number of items that I have to talk about on the slide will start to reduce, but we've still got quite a bit of change going on in the business, and therefore, as you would expect, I'm happy to take obviously questions later, but there is a lot of things happening in the group, and I'm just going to talk through each individual line item just to try and help understand, make sure that you understand what's going on. The first thing is obviously the pension indexation change, and this was really made in connection with the refinancing that we obviously signed in April, and this was agreed with the trustees as part of that refinancing. And this is a move from RPI to CPI, not for all populations, but for substantially most of those populations where we have the opportunity to do that. And that's worth 67.8 million in terms of our pension liability, and we've reflected that as a gain. This is not cash, obviously, in the short term, but clearly over the long term, as we factor into our actuarial valuations, we would expect that to come through, and therefore going forward, we would see a cash benefit. What it also means is that in the short term, however, that our balance sheet position changes from a net liability to a net asset. The gain on the sale of Haymarket reflects the market interest that we saw in that asset as we sold it. Although we wrote it down in 2017, we were able to run a very competitive process, and that generated a gain on the written down value, although not quite back to our original investment write down. We went through the contract review in terms of at 2017, and therefore this is sort of the first time that we've seen the comparators of what that has what the 2017 impact was. The current period charge is a combination of the net change in our forward loss provision on the CRC contracts, which are the probation contracts for the MOJ, and the US Forces Prime contract. And the net impact of that is about £5.7 million. One was a gain and one was a further increase. That was the probation contracts. And we had a net further loss of £1.1 million on all of the other contracts that we had provided for. Some of those were gains and some of those were additional costs. But overall, clearly, we feel that the provision that we made for the bulk of those contracts that we identified in 2017, we were pretty close in terms of what that impact was. The amortisation of acquired intangibles was consistent with previous year, but following the write-down of goodwill that we took last year, you can see that we've seen a lower charge in the current period compared to the first half of 2017. I have a separate slide on energy from waste, and I'll talk through the operational progress on that slide. However, I wanted to just cover the financial impact here. As we stated in the announcement, we have, following the adoption of IFRS 15, changed our accounting for the insurance proceeds relating to the energy from waste contracts, as the insurance proceeds are not a function of a contract with a customer, but a third party. And accordingly, we are now, in essence, accounting for insurance receipts on a cash basis, as we will only recognise them when they become virtually certain, which is the test under the standard that we now have to apply with respect to those insurance proceeds. Therefore, in the first half of 2018, although that we believe that in total the insurance proceeds will offset these cost increases at some point in the future, we've not recognised these in our provision calculations. The 11.2 million is a net number of the incremental costs in the period, less the sort of £8 million of proceeds that we received in the quarter. The next item, the exit from London construction, really follows a review of the regional construction performance that we undertook, and we've taken the decision that on the basis that we couldn't fix that business and we would exit that business, although we continue to operate our fit-out business in the region under the brand Paragon. The £15 million impairment of write-down of assets is a non-cash charge and is within a business that we're trying to sell inside support services, and this item is obviously unrelated to the impairment of assets that we took in 2017. They are completely, obviously, different assets. Advisor fees were just over £32 million of the £42.9 million charge, with the balance of the £42.9 million being restructuring costs related principally to Fit for Growth. In total, the total cost of the refinancing on top of the 13 that we paid last year comes to just about £45 million. And then finally, the FX loss on the USPP notes, the £7.8 million, is a function of the exchange rate movement in the first half between sterling and the dollar. And obviously, this reflects the requirement that we had to do to terminate hedging in December as part of the new money financing that was agreed at this time. Turning then to the cash impact, and just to try and clarify this, and the first sort of line on this is really and these excludes energy from waste, is really the cash profile that we showed at the end of 2017. So the 2018 impact through to 2019, that top line, a £45.8 million aggregate outflow from all of the cash flows that and non-underlying costs that we had identified in 2017. Updating those flows for events in the first half, and obviously the new items which have a cash impact. I'm just going to talk down each of the individual line items. Obviously, pension indexation is the biggest impact. That doesn't have an impact in the near term because we have agreed minimum contributions with the pension fund over the short-term period as part of the refinancing, and therefore that cash benefit will at some time come through, but it will be beyond 2022. The impact of the contract review and the agreements that we've made with CRC and the MOJ contracts actually impact to worsen cash flow in the short term. So you can see an increase in 18 of 3.4 and the 19-22 period of 7, and that's offset by the gain effectively in the 2022 and beyond period, as we, in essence, the early termination benefit of those loss-making contracts means that we no longer have those cash costs. London construction, the exit should be completed this year, and therefore we would anticipate the cash costs occurring in this year. And then obviously the advisor and restructuring fees have been paid in the first half and are therefore included in the current year, as are the proceeds from the property sale of Haymarket, which was also completed in the first half. So turning then to the financing costs, and what we've tried to do on this slide is sort of try and help show the impact of the new facilities and the incremental facilities that we've put in place, and some of the items that are feeding into our total finance cost at the moment. By way of a reminder, obviously, the new facilities, which had increased costs on the old money as well as the new money, were only in place since the end of April, but we did have costs in connection with the additional funding that we put in place in December, and so an impact on that is reflected in these numbers. There is a significant amount, as you can see, of non-cash costs, as well as so that we had £19 million effectively of cash charges in the period and 11 roughly of non-cash charges. And you can see that as going forward, we've indicated that for the full year we'll have about a 40 million cash charge and a 40 million non-cash charge. The biggest, one of the items, and I will come to it later when I talk about the net debt, you can see is the unwind of discount re the warrants. So I'm going to give a Richard Pillman masterclass on warrant accounting at some point. Where's Richard gone? Right. Turning then to energy from waste. Obviously, and we are pleased with the progress that we made, and as you can see from this slide, all of the facilities that we are responsible for the building on, we've built. All of the facilities are burning, and actually in terms of generating electricity, which is their purpose for being built, clearly you can see Derby, Rotherham and Peterborough are all working, and Dunbar and Margam we expect to start generating electricity this month. You can, if we look at in terms of where are we on handover dates, and obviously you can see between the third quarter and the fourth quarter, we would expect to complete and hand over all of these sites. And that said, however, we aren't expecting the risks themselves don't all completely go away once we finish that. And obviously, as we're in the commissioning phase, we are still focused very much on making sure that these sites operate to the levels that we expect of them. We have reached an agreement with BWV around the allocation of liabilities incurred to date and through to September on the sites that we operate with them, which are Dunbar, Margam and Rotherham. And then the last thing really is around the cash profile. And you can see in the first half, we obviously had cash out of about just under £40 million. For the full year, we're now anticipating a roughly £8 million outflow. So if you do the maths, roughly we're going to get about £32 million in the second half, and therefore that is, we have reached an inflection point in terms of cash and cash profile, and that's a combination of milestone payments that we will receive partly as a result of the deal that we've agreed with BWV, as well as continuing to receive insurance proceeds and progressing those insurance claims. Turning then to sort of what does that mean in terms of overall cash flow. We did see a significant further working capital movement in the first half. Roughly 50 million of that I had flagged at the year end, which we knew about, and that really came out of some of the VAT, our time to pay arrangement that we had with HMRC, as well as obviously we saw a benefit in terms of early receipts that we had flagged in from 2017, which customers paid us early. We particularly love those customers. And obviously there's the construction impact of working capital unwinding as that business actually shrinks somewhat. Forward loss provisions utilised in the first half were about 15.4 million. That is a coincidence that that's exactly the number on the previous slide that I talked to in terms of the cash impact. It is just a pure coincidence. Finalising the flow of movement and change in net debt. Energy from waste I've obviously talked about. The 73.3 is really the impact of the non-underlyings that I've also already talked about. The pension contributions, the issue of warrants, that is a recognition of the £35 million of warrant benefit that we got and the treatment that we received. So although we issued the warrants effectively for free, in a sense, or for 10p, the accounting treatment is that we in essence recognised 35.7 million of the 175 million that we borrowed effectively as being the fair value of the warrants that they issued. And then in essence we have to then amortise that £35 million over the life of the facilities based on the amount of the facilities that are available. And therefore, when we get down to the net debt number, one of the challenges we have in terms of the net debt is that we had given guidance previously before the warrant amortisation of 650 to 680 million. We came in at about 645.8, so just under that guidance. And in terms of, but if you take off the warrants, that brings the net debt number down to 614. What we have said for the full year guidance on a comparable basis with the warrant add back effectively, we're saying that we expect net debt between 575 and 600 million. So we are expecting to see cash generation in the vicinity of between 45 to about 70 million pounds in the second half is in essence what that means. And with that, I'm now going to hand back to Debbie. Debbie.
Thank you, Mark. A lot of moving parts there, but hopefully we've explained them well enough. Of course, at the end of the session, we will have a Q&A opportunity. So I'll now run you through a reminder of our strategic priorities, an update on progress on Fit for Growth, and then, of course, an individual business line performance in the first half, and then a little bit of a flavour around what are we doing in support services, which obviously with the competitive landscape, we don't want to say too much, but I also do want to bring to light some of the activity within the support services business. And then, of course, I'll close with the outlook for the year. So this slide hasn't changed. We shared this with you in May. Each of the businesses are now working through what this means to them and how it should be implemented within their different business lines. I think what's really important and has been a change in the last few months is that now this is being embraced by the senior leadership team. The executives and the senior leadership team are fully engaged in delivering the One Interserve approach, to leverage our scale, to standardise our approach to finance, to HR, to IT and procurement. And that is a significant behavioural change within Interserve and can't be underestimated about the amount that will absorb of us in the coming months and years. Again, you've seen this slide before. This is the one we shared with you in May. As a reminder, our commitment is an improvement of 15 million in our cost base in this year and 40 to 50 million by 2020. So what have we been doing in the first half on Fit for Growth? Our organisational redesign has eliminated over 1,300 roles across the group. In the execution of this, we've redeployed people, we've used vacancies to minimise the number of employees and the capability leaving the group. But at the end of the day, we have taken out 1,300 roles across the group, principally in overhead, but to a small degree within contract margins. We've strengthened the management team with the appointment of a new group head of legal, a new group head of procurement, and the leader of our IT, HR and transformation activities, all of which will play a key role going forward. We've completed a thorough review of our property portfolio and have exited or have plans to exit 40 of the properties that we inherited 6-7 months ago. We have, very importantly, maintained control over discretionary spend and recruitment and systemised a lot of the processes underpinning those activities. In terms of what's to come and where we're now focusing our effort, as I've already said, it's about how we deliver back office services across the group, how we leverage our scale, and we'll be concentrating on this across the senior leadership team in the second half. Moving on to the trading and financial performance of each of the businesses. In support services, if one excludes the sale of PFI assets, which was recognised in the same period last year, revenue is slightly down, reflecting contract losses last year, and the margin is broadly flat. Versus the second half of 2017, the margin has improved by 110 basis points. This reflects the stabilisation of the business and the impact of Fit for Growth. In the first half, we mobilised our 2 largest contracts ever, whilst also substantially completing the negotiation of 2 large onerous contracts which were provided for in 2017 that Mark has already referenced. And in the second half, we expect momentum to be maintained as we stabilise the new contracts and have the full impact of Fit for Growth in our numbers. Our construction business generated a margin of 1.8% in the first half. Within this, our international business has seen trading drop due to the Qatar trading embargo and a softness of business within the UAE. Now, across the construction business, both in the UK and internationally, we remain very selective and have maintained our margin expectations as we bid for new work. We're consequently de-risking the portfolio and moving towards smaller, more manageable projects. Again, we expect to maintain the current level of performance into the second half. Now, equipment services, as Mark has already referenced, has had a challenging first half, and this is due principally to 3 main reasons. A lack of infrastructure projects in the UK. In the comparable period in 2017, we had a large number of UK infrastructure projects which have not been repeated in the first half of this year. The Qatar trading embargo, and a lull in the activity in the Hong Kong infrastructure business. Now, the management team are focused on the introduction of new ground shoring products, not only in the UK but in other select territories, and on ensuring the engineering design capability is targeted on our most attractive projects. The second half anticipates a pickup in activity based upon the current level of quotes and prospects we have in the order book. Let me move on to the support services strategy. We've completed a thorough review of the support services business in the UK. We've examined our strengths and weaknesses and have concluded on the plan for how we might create maximum value for our shareholders, customers and employees. In outline terms, it's key to note that we have a good penetration of both the public and private sector within the UK, and that over time we aim to keep this. More details on the priority sectors will be covered in a moment. The pipeline has been thoroughly reviewed, stripping out work which no longer fits with our direction, and we've developed a target accounts portfolio. Now, I'll cover in a moment our approach to self-delivery. It's important to note that this has not historically been a focus for the business at Interserve, but for me, it is key both to reliability of performance and to margin management. As we've said previously, being close to our customers and people is key to running a successful support services business. Our new operational organisation design enables this. In support services, month in, month out reviews of contract margin, labour cost, productivity, safety and client KPI trending is key. We will need to invest in some of the processes going forward to ensure that the data we have is both timely and accurate, but also, importantly, very reliable. So the bottom line is to return the business to above sector profitability. And these are the goals that are laid out on this page that we are sharing throughout the support services business. So today, I just want to bring a little bit of colour to two elements of this, our target sectors and our goals around self-delivery. So historically, Interserve and its acquired businesses were good at retaining clients and services. They were somewhat driven by the market, I think it's fair to say. Going forward, we'll focus on those sectors which have significant opportunity for growth, where we have good referenceability and are well placed to grow. Within this, we will still have to be selective and we'll have to target our bidding on opportunities which will deliver the most sustainable and value-driving performance for the group. We will, of course, also be selecting relationships where we can deliver a full range of services and ensure that we're delivering the best of Interserve to our customers. Moving on to self-delivery, this was a little bit of a revelation for me, I have to say. So the financial and operational model of a resilient and sustainable support services business requires very strong, repeatable self-delivery capability. And I'm really confident at Interserve that we have this, but we've not been disciplined in applying it consistently across all of our sectors and all of our contracts. The support services senior leadership team recognise this and are now committed to significantly moving the needle, accepting that there will be some specific service lines which should be subcontracted and that we should not self-perform. So there's been a huge amount of progress in developing the support services plan. There's an awful long way to go, but I'm confident that we have the key elements well defined and deliverable. And finally, to close, our current trading and outlook. Half-year trading, as we've said, is in line with our expectations. It has been an incredibly busy first half, I'm sure everybody will agree. We continue to tidy up the portfolio and, of course, focus on implementing Fit for Growth. The completion of commissioning the energy from waste plants is a priority and, as I've said, has had laser-like focus in the last 6 months, as is the finalisation of our insurance claims on energy from waste and closing out all of our commercial negotiations. And across the group, future workload is stable and, importantly, full-year expectations remain unchanged. Thank you. Excuse me. And we'll now open it up for a question and answer. We do have mics, and given that we're recording this, I would be grateful if you would indicate if you'd like to ask a question, and please state your name and organisation that you belong to. Thank you.
Morning there, it's Sam Bland from JP Morgan. I've got two, please. First one is on these financing costs. I can see you've got expecting about 80 million in the full year, 40 cash, 40 non-cash. I can see roughly how you get the 40 of cash, 18.8 in the first half, times by 2, somewhere close. The non-cash in the first half was about 11. Can you just kind of explain how that then steps up to something like 30, I guess, in the second half of the year?
Sure. So
and what that might look like next year.
Sure. So thanks, Sam. So clearly, what you have in all of the non-cash incremental items, because obviously we didn't have any sort of non-cash really last year, are effectively relate to 2 months. So as you say, you've got roughly you've got 2 months worth of those, and if you were to take that, you've got 11 million times 6, you'd end up at 66. So actually, you might end up and say that 40 seems a little light. But actually, the way it works is really a function of the profile of our debt profile over that period of time, and also around the bond issuance, etc., and expectations. So it's not quite as formulaic as that. But obviously, we've got about within that, you've got about £12 million of effectively the warrant unwind that we would anticipate. And that is a function of the quantum of debt outstanding. You've got payment in kind, which accrues roughly evenly. So you're going to have roughly £15 million of that. And then the balance is really the amortisation of the lender charges and the back-end fees that we've got in connection. So that's sort of roughly the build of how you get to 40.
And second, if I can, just maybe a little bit more colour on the international construction equipment services businesses. Had a little bit of a tougher H1 because of some of those markets. maybe a little bit more of a flavour of any sense of improvement in the second half of the year, seeing anything getting better on the ground? Thanks.
Yeah. As it relates to equipment services, RMDK, yes, in fact, we've already seen an uptick in activity at the back end of the first half in June, and that's continued through July. So the number, our prospecting and quotes has uplifted significantly compared to the first half. I think trading conditions will still be challenging in the Middle East. As we know, the Qatari situation has become very entrenched, I think it's probably fair to say. So we won't be seeing any change there, but certainly in other parts of the RMDK business, there is some good, strong performance. We've, of course, also got the introduction of our ground shoring products beyond the UK, and as I've said, the team are very busy making those happen and choosing the right countries in which to put those products. As it relates to international construction, we took a decision at the beginning of the year to maintain our margin expectations, particularly in the UAE, on international construction within that construction business, and that was principally because there were some new entrants in that market who were coming in sort of undercutting prices, but our view was that was not sustainable in the long term, and in fact I think that's fair to say that has played out. So we're seeing the order book in in the UAE in particular picking up, and in fact anticipating some reasonable wins in that market in the second half.
That's great, thanks.
Good morning, Joe Brent from Lieberman. 3 questions, if I may. Firstly, on the interest for the year, certainly higher than we were expecting. What sort of changed in your guidance? I understand the components of the interest charge, but why is it higher than I think many of us thought before? Secondly, net debt, we've not talked about it, is the elephant in the room. Clearly a high level. What level would you be comfortable with, and what are the measures you think you might be able to take to address that? And thirdly, a specific question on the actuarial deficit. Do you have any sense of where the deficit recovery payments may come out post the actuarial review and post the CPI change?
Okay. Do you want me to do finance first? The finance cost, I mean, when we did the original estimate, there was a couple of things. One is, I think in the terms of the guidance at that time, we weren't sure what the accounting was going to be for the warrants. So I think roughly, I think we'd sort of anticipated sort of 55 to 60. Roughly, there was about, in essence, that's going to cost us about £12 million. And therefore that was part of the difference, and there are alternate accounting treatments for warrants which we hadn't concluded. And then the other thing is that the phasing of the warrant cost and the recognisation of the amortisation is driven by the quantum of debt, so it almost works as a weighted average debt number drives when the warrants effectively are recognised in terms of the expense. The other element which I think is important to understand is if you look at our balance sheet, cash on the balance sheet at the end of June this year was about £194 million. That compares to about £153 million that we had on the balance sheet at the end of June last year, and that was after quite a substantial, cash drive in terms of last year's number. And therefore, what we have, and we didn't do any sort of withholding or payments. It's just been business as normal, and therefore, what we have is under
the new regime.
Indeed, and what we have is a more inefficient balance sheet fundamentally, and I think we've just underestimated the inefficiency in our balance sheet. Having £194 million of cash, which gets virtually no interest, and you're paying roughly 10% on a borrowings rate, doesn't actually help our finance costs a lot. So that's really the substantial driver in terms of that. Did you want to comment on what amount of net debt you would like to be? Less than now would be my answer.
Well, I won't repeat the story that my parents never had a credit card, so I'm not used to any debt at all. But that is the situation. I think the board are undertaking a strategic review of their options as it relates to debt reduction, as you would expect. And we will progress that through to the third, fourth quarter of this year. So we'll progress those discussions. I don't think it's right at this point in time to give a number. Yes, I do have a number, but I don't want to mislead anybody. Mark might be more willing to give a number than I am. But we will be doing a strategic review of what our options are to take debt down over the course of the next year.
So obviously we have given a view on what we think the year-end net debt will be for this year because we have visibility, but only obviously through the end of this year. On the actuarial valuation, that is underway as we speak, or as I speak and we sit here. It's because it's effectively the payments are effectively we agreed as part of the refinancing. They will be there is a minimum amount. It'll be obviously the indexation does have a positive impact, and so at some point, if you say you've got an average service life of 15 years and you're reducing it by just over 60 million, you would expect contributions to come down by sort of circa £4 million a year, all other things being equal. But I think part of it is around obviously interest rate assumptions and all the other assumptions that go into the actuarial calculation, as well as investment returns. As you know, the fund was de-risked a couple of years ago, and clearly we will continue to work with the trustees and look at what is the appropriate risk strategy that the trustees have with respect to their asset and investment mix. They did take a more conservative position at the beginning of the year, given the situation with Interserve. Effectively, one of the things we would like to do is work with them to effectively re-risk where it was appropriate in terms of their investment strategy. So until we get the conclusion of that process, and that's really going to be a function of when do we get our balance sheet sorted out in a sense, then we'll go back to a more sort of normal actuarial valuation. I suspect at the moment we're sort of in a period of stasis while we just sort of get through to the other side.
Thank you. Howard Seymour from Numis. Three if I may. First two on support services, one specific on the business. You allude to the major mobilisations in the first half, whether there was a physical or disruptive cost of that in the first half, because obviously they are substantial. And secondly, Debbie, you also allude to the, if I just stay on that one, the self-delivery. Do you perceive that the self-delivery that you can do is with the capability that you've already got, i.e. make people busier, or do you need more people to do that? And also you alluded to having to invest. Any thoughts on IT investment? And I'll come to my third one, if I can, on energy for waste, if that's okay.
All right, so I'll do those. Yeah. So the mobilisations were incredibly challenging. They were the largest that the group has done, and probably some of the largest actually across the sector that have ever been done. They are margin positive in the first half, albeit there's a lot to do to get those contracts stable. Not surprisingly, that is not that no one should be surprised by that. We're 3 months in on one and a little longer in on the second. And with the numbers of people that transfer and the number of buildings that transfer and the asset reconciliations that has to go all along with that, it is an incredibly busy period. But in the first half, both contracts are margin positive, which is very good news. By anyone who knows the sector, that is good news. In terms of self-delivery, the business has historically the contract manager or account director has had the right to choose whether they self-perform or not self-perform. So it's not a matter of... so we have the capability, right? Across all of the main service lines. We have also done a service line review, and I've not included it today because it is somewhat competitive information. I don't really want to be too transparent with it. But across all the major service lines, we deliver services in the UK at the moment. But the choice of whether we self-deliver or don't has been taken at a very low level in the organisation, which isn't the way to manage your margin or performance, in my view. So we will be stopping that approach and introducing more discipline. And as you saw, we have set, or the team have set themselves targets actually for where they want to get to on self-delivery. Underpinning that, we will of course be standardising the services as well. So again, much more repeatable, predictable, both in terms of quality of service, but also financial performance. In terms of investment in IT, we spend tens of millions of pounds on IT today. And we are again undertaking a huge review of our IT infrastructure and of our business IT strategy. Will it mean over time that we'll have to spend more? I seriously hope not. I hope we can redirect the current spend in the appropriate way, but we have very ageing infrastructure in some places in the group. I think at the full year results presentation I mentioned we have 40 ERP systems. Right? Those have got to be closed down into a much more sustainable, and we've got to use, I hope we can leapfrog actually some of the technology solutions so that we are totally up to date and ahead of the pack rather than behind. But at this point in time, I can't give you a number on any additional IT investment.
Energy for waste was my last one, really. And just on the premise that there's been a change on the IFRS 15, I'm trying to understand, of the 11 million in the first half, how much of that is a function of the fact that the costs at Derby, for example, are higher, and how much of it is the accounting change that you put in? So if you hadn't changed the accounting, would there have been a number at all?
So if we hadn't have changed the accounting, we probably wouldn't have had a number. Yeah. Because in essence, the insurance proceeds, we are working very hard, as Debbie said, on the insurance claims, not only in respect of Glasgow, where we've got 2 claims, but also now in respect of Derby, which obviously is the fact pattern in Glasgow from a technology standpoint. The subcontractor went into liquidation. There's a number of the design issues which caused the claim in Glasgow. They're the same issues effectively at Derby. And actually, as we develop those claims and complete the work, we're probably becoming more confident on the insurance claims. And if we'd have accounted for it on a consistent manner, we probably wouldn't have had anything in that column on the basis that overall our net position was still unchanged.
Thank you. Sorry.
Thank you. Hi, Stephen Rawlinson from Applied Value. Just a couple of questions from me. Just on the debt position, could you just shed a bit more light on the average daily net debt, please, and the peak net debt that you both had in the first half and that you expect in the second? And secondly, with regard to the work for the DWP and the DOT, those were bid before you became chief executive, I would guess, Debbie. Therefore, 2 questions. Firstly, are there risks in those contracts for central government that you would prefer not to take these days and probably wouldn't include in such tender processes? And secondly, one of the issues has been with such contracts, the reconciliation of people and assets, as they're not quite what was in the tender documents in the first place. If that's the case, then are you able to recover any additional costs that are a consequence of the asset register or the people register not matching what you tendered against?
So in terms of the debt and average debt position across the half, there's a couple of comments. One is obviously we're not managing our working capital in the way that has been done previously. So the debt profile of our business is effectively a pure debt profile of what we're doing in terms of our trading performance. So the difference between our average in terms of what you'd expect is not distorted in that same regard. In terms of the numbers, and I'm going to use the numbers with excluding the warrants because effectively that makes it comparable to our starting position. If you remember last year we finished year-end net debt was about 503 million. We talked about effectively timing payments which were in the first week of January of about 50. So our sort of adjusted starting year-end position was about 550. We've obviously ended the first half at about 645. And the average balance across that period was about 616. So that's sort of consistent with what you'd expect. Going then to the second half and expectations, excluding the warrants, we've sort of given guidance of 575 to 600. Starting position is 645. The average for the second half will probably be somewhere between 600 and 620 would be my guess. So probably not that dissimilar, funnily enough, from the first half. The second question?
Yeah, I'll cover that. I was just going to say, so you won't be surprised to hear that we track debt daily, and there's a little bit of a competition to who can see the email first. So we know exactly precisely what the number is every day. So, and I would concur with what Mark said on that. In terms of DWP and the Department for Transport, yes, it was bid before I got here, and yes, it was bid on the existing Crown Commercial framework that was in place. Again, I'm pleased to say that we have been allocated, or we've retained our position on the new framework, which is good news. So the risk profile is the risk profile broadly you'd expect with central government contracting. So there's no new news in there. But you make a really good point on people and assets. So, I hope none of you have watched the Public Accounts Committee hearing, but one of the things that I did say, in fact my main message to the MPs was data makes the difference between a good and a bad contract for both parties. But any additional buildings or people in these two contracts result in variations. So we are very closely managing variations, and the slight challenge is getting those variations agreed quickly, getting them signed off quickly, and getting them billed. Because what happens if you don't do that is you end up with a fairly sizable number in work in progress on the balance sheet, and we are, of course, tracking that very, very carefully. So, yeah, so we get variations on people and assets.
Yeah, just as a follow-up to that, I mean, there have been situations where that particular client has just said, yes, we know there's variations, but tough. What's your thought process around that, if that's the reaction?
I'd go back to the contract. If the contract says you can have it, you go for it.
It's Kevin Kamak at Senkos. If I can stretch it to 4, but they're all fairly straightforward, I think. Firstly, you mentioned something about reorganising your use of property, and I think you said you'd identified 40 properties that would be surplus to your requirement. Could you just, in any sense, give any colour as to the carrying value of those, whether they're lease or freehold, what ultimately you might recoup back into the balance sheet if they're sold? Secondly, and I'll put my hand up straight away to being a complete idiot when it comes to pension funding and all the rest of it, but on the slide on the future cash flows, the assumption was that all the 68 million effectively comes back to you as cash. Does that actually mean, in a sense, you've fixed this transfer when it was made? Because my presumption would have been that relationship between moving from RPI to CPI presumably changes every year in the next 5 years. So I'm just unclear as to how the certainty of that, how can you be certain that actually does come back to you in cash terms? The third question, again, is quite specific. In looking at the UK construction, when do you see the sort of top line flattening out to the extent that the working capital outflows, not necessarily reverse, but at least are arrested? And the last question I had was really just a general one. Given everything that's been going on in the support services market, and I'd just be interested to know your views on how you feel going forward. Customers in both the public and the private sector may have changed, or if you think the future is going to be different in any way, shape or form as a result of events post-Carillion.
Do you want me to start?
You do property.
So property, most of those facilities are leases, and therefore there's no real asset realisation in terms of cash back into the business. There is a cash benefit in terms, and obviously last year, if we can sublet it, and last year in the restructuring charges we did make a provision for onerous leases as part of that overall provision that we made. So in terms of a P&L impact, if those leases aren't being utilised, then obviously the facilities aren't being utilised. As obviously, we've mitigated that impact in terms of a P&L standpoint. We are looking at consolidating at a number of sites currently in terms of the amount of space and density. As Debbie said, in total, the number of people and roles that have been eliminated, sort of 1,400 clearly says that you don't need as much space within the buildings, and therefore we are doing what you would expect in consolidating our occupation and our footprint from a physical standpoint. There's no big windfall in terms of from that. On the pension funding, and it's my apologies if I've misled people to suggest that we're going to get £60 million back from the pension fund. What we were trying to show was what the cash profile would look like as a result of those non-underlying items. And relative to the baseline of where we are today, at some point in future, if we hadn't have agreed that, then all other things being equal, we would have had to put £60 million more in based on the current set of assumptions. And I accept completely your point that it does change. So the intention was sort of show that there is a future cash benefit, potentially, of that quantum as a result of the agreement that we've done with the trustees. Whether that actually ends up being the final cash contribution and how it unfolds, that will obviously be determined based on the actuarial valuations that we do on a 3-yearly basis. So it was more to try and show what was the impact of the non-underlying items rather than say that we would get a cash inflow.
On UK construction, our current view is that it should level out this year. So we should see the working capital outflow be a 2018 impact. But I would maintain my comments around margin expectation and selectivity driving the right business decisions rather than the working capital outflow driving a decision. In terms of support services market, I think it's potentially a very different space to be operating in, but I don't believe the UK will move that quick to recognise the reasons why Carillion failed. The public sector are taking a long, hard look at how it engages and works and outsources services, and I think that's very welcome. And we are actively engaged, as are most of our colleagues in the sector, in working with the public sector on how things need to be different. I think one of the things that we can expect to see is that our clients and customers will expect a living will. For any significant service delivery, they will expect to see that, and rightly so, really. I think, so I think we can expect that major change going forward.
Just generally, do you think, if you look out the next sort of 3 years or something, do you think it's more or less likely that the public sector will outsource? Well, when I say public sector, I mean A, central government, B, local government.
I don't think it'll change. I think the market is pretty stable. I don't think you'll see any new services being let, but I think the current book of business will remain.
Thank you.
Any other questions? No. Well, thank you all for attending this morning. It's very nice to see everybody again, and we'll see you all in the new year.